I was pulling the wrong volume there for the intro music, lowering the volume of something else along the way. Anyway, good morning, everyone. Welcome to Coffee with Carlson. Thank you for joining me. A couple days ago is my birthday. Thank you to everyone on Facebook world that wished me a happy birthday. 51 years old, felt great, had a good weekend, hurt my thumb, still played golf at 18 holes, didn't hurt too bad, and made it through it. Had a great time in Jacksonville with some friends, and it was a wonderful weekend. Thank you, everyone, for the birthday wishes. We're going to jump right in. Today is March the 8th. I can hardly believe it. March the 8th. We're moving right along. Hope everyone is enjoying their nice warm cup of strangely warm coffee this morning. Today, I'm going to follow up on last week's discussion by talking a little bit more in depth about the Power of Zero book. But in this time, I just want to spend a few minutes talking about the life insurance retirement plan that was mentioned in the book. I've done some more research. I had my buddy Dusty Johnson over at Johnson Stivender run some numbers so I could show you all some real world examples. There's a lot of pages on the presentation they sent over, so I'm going to pick a few of them and show it up there so that you can see it all along the way. It should be pretty cool. It's not as, the strategy's not as crazy as I thought it was going to be, but it was a lot of fun. Today, I want to give a shout out. Told you last week I'm going to give a shout out to my customers every week. Today, I'm going to give a great shout out to Sandy over at Sandy's Cafe on Highway 98. And if off 27, a couple miles right there where County Road 17 curves off to the south. If you haven't been by there, check them out. They've got fantastic food. Sandy and Cy cook well, fun to talk to. Get out there, see them for breakfast or lunch. And thank you guys. We have team meetings every week. And sometimes they'll come by here to pick up their work and bring us some lunch. So we love it. Thank you very much. Stop by Sandy's Cafe if you get a chance. All right, guys, we're going to jump right in. I'm going to try my handy dandy picture-in-picture. Look at me up there. Watch. Whoop, 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 whoop. Where do I fit best? I think down there might look good. All right, so quick rundown of what the life insurance retirement plan is. The basics doesn't really even need that name. But the idea is that a life insurance retirement plan is really just a whole life insurance policy where you have a life insurance component and a cash value that grows, but you take a little bit different tact on the way that you design the plan. And there are lots of caveats here. So you need to meet with your CPA, your financial advisor, to really get into the details of how these numbers work and how they play out with you. Just kind of picked an arbitrary, with my age, 51, and a fixed amount to come up with the example that we have. But in general, it's just a whole life insurance policy. And the change that you make is normally you're trying to maximize death benefit in a life insurance plan, in a whole life plan. And you pay it for a certain number of years, and then the cash value grows to help pay and I'm no life insurance expert, by the way, but you want to get a life insurance policy. The cash value will help cover that as you get older in age. That's kind of the way that it's designed. In this particular scenario, you're going to design it a little bit differently. You're going to design it so that you get the smallest life insurance policy that you can buy and accumulate. The goal is to accumulate cash value. And the idea presented in the book is that I buy this small insurance policy. I put money in that it has no technical limit, but there are some things that would limit the amount that you can accumulate in there. And then when I reach retirement age, there's no requirement to distribute the cash. There's no tax on the cash if, as the book describes, you take out loans against your cash value. You don't actually withdraw the cash value. And then at your passing, the life insurance policy and the cash value would cover whatever the loans were that you had previously taken out. A way to get around getting some tax-free money. Now, the interesting thing is that if you actually do pull the cash out, not as a loan, it works kind of like an annuity in a sense that you're going, or a a non-deductible traditional IRA where you're going to pay tax on the earnings that you had as a percentage of the total value versus the amount that you put in or contributed to the plan over the years. So this sheet that I've got up here really just kind of breaks down 3 different buckets of tax dollars. The first one is tax deferred, traditional 401ks, IRAs. Those are funded with pre-tax dollars while you're working. And the idea presented in the book is that I only want to put money in there up to the amount of match that I make. And my buddy Dave Ramsey is a little bit different than that. We want to max that out as much as we can. Comes out of your paycheck. There's a lot of advantages to doing that if it's offered at your company. The next one is funded with tax dollars. This is normal after tax, normal brokerage accounts, not inside a retirement plan that you would accumulate. Those aren't all taxed when you pull them out. You're still going to pay tax on the gains that you create inside the account when you sell those things. And then the final one, this tax advantage would be Roth. If you can, so the idea that this guy gave out was I'm going to maximize my 401k contribution up to the amount of the match. So I basically get 100% return. Then I want to max out the Roth IRA. So that's $6,000 a year. And then I can put this plan in. And normally what I do with my customers is I ask you, how much do you want to put in per year? How old are you? What are your goals? And that kind of helps us determine which plan you're going to go into. Certainly want to coordinate that with your financial advisor. So let me, if I could scroll down here, what we did in this example, and the idea with this book was that you're going to get into the zero tax rate when you reach retirement. So there's lots of discussion in this about what you're going to get out of it. So here's what I wanted to show you, that this real example of if I enact this plan, I get this life insurance retirement plan set up, I fund it with after-tax dollars, then later on down the line, you design it for a specific withdrawal amount in the future. That's kind of how the plan is designed. So in this particular case, they designed it with $11,672 of this lending capability. I get the $11,672. It's not taxed, so I'm going to get a net cash of $11,672. They assume in this case that you're in the 28% tax rate. I think a lot of these examples use a higher tax bracket. I think that's probably a little bit high, but for argument's sake, whatever it is, even if it was 10%, you're still going to lose $1,672, or sorry, $1,167 if it was 10%. So you still lose $1,000. So you're getting less money if you're going to pay tax on it. So you can see the advantage here that in this scenario with a 28% tax rate, I would have to pull out $16,211 to get back to this $11,672 net cash flow from this plan. So that's kind of the way that the plan is set up. Obviously, there's a life insurance benefit. This particular example was 10 years of $10,000 per year paid into the plan or a contribution into the plan, and then withdrawing money from the plan from 65 to 84 and seeing what those distributions would be. Total distributions that would be tax-free are $233. The 7% in this case was the assumed earning rate of return in the example, and you can see to the right what the death benefit would have been at any of those times. So it's not very large, but if I passed right at the point where I finished paying, then I would get the largest benefit, and it goes down and down, but all the way up to age 126. I'm not sure I'm going to make it that far, but thank you for them for being optimistic. Good morning, wife. Thank you for watching. Can't wait for you to get to the office. I hope you're bringing lunch. So that's kind of the example. There's all kinds of other things in here. Your financial advisor can run these numbers for you and see if it makes sense for you. If you're close to or already in retirement, obviously you're not going to have the accumulation period to do this, and your life insurance is going to be a little bit more expensive. But remember that planning for retirement is, you have to take a holistic approach. You can't just think, I'm going to put a few $1,000s into an IRA, I'm going to put a few dollars into 401k, a Roth, wherever it is. You really need to sit down and crunch the numbers and see where you want to be when you retire and figure out which plan or mix of plans has the best option for you. Now, the other thing to think about with this plan is the money's not really liquid, so it's not something that you can really get. At the top where that had those charts of pre-tax, after-tax buckets of retirement money, So the middle one here, funded with after-tax dollars, your normal brokerage account, is your most liquid, meaning that if you needed to get that money, you could get to it as much as you wanted to. So there's lots of strategies involved here. Think about liquidity, time frame, rates of return, risk that you want to take, and how much you're going to need when you retire. Sit down with your CPA, sit down with your financial advisor, and talk to them about what your goals are and where you need to be. So I think that's just about it for us today. If you have any questions about this show or any of our shows, check us out at carlsonaccounting.com to learn more about me and our firm. Give us a call to set up an appointment anytime at 863-382-4141. Or you can even go to our website, carlsonaccounting.com, and set up an appointment for me right there. Just let me know if you want to meet virtually or in person. We're here every day, so you can stop on by and see us and grab a cup of coffee. We appreciate your time today and hope that you garnered a few bits of knowledge from the day. Thank you very much. Have a wonderful week, and we're out.